I put off investing for the longest time because I thought it was complicated, even though I worked in banking for 5 years. Unbelievable, I know. But the truth is, investing in a way that grows your wealth is actually very simple. So today, let's talk about 9 simple things to know to get started with investing. And my bonus tip at the end is a kind of a meta level insight I learned about investing that grew my wealth even faster. A quick disclaimer, guys, the following is just my opinion and not investment advice. I'm not a financial advisor, I'm just sharing my experience and learnings here and hope that it can be useful to you. So I read this article and it's crazy and sad that only half of Canadians put some money into investments each year. This means that about 50% of Canadians don't invest in anything. Many people think they need to wait until they saved a couple of $1,000s to take the plunge. But here's how much money you lose by waiting. If you'd started investing just $100 each month, if it grows at an average rate of 8% per year, after 5 years you would have $7,298. Now, if you'd increase your investment amount by 20% each year and stayed invested over 30 years, you'd have almost $2.4 million. Now let's see what happens if you delay investing by another 5 years. With that same $100 and 25% increase in investments each year, you'd get to $917,000, which is less than half, just because you started 5 years later. You see how a lot of that growth accelerates at the end? So make sure you don't delay investing, but start early, even with small amounts. Getting started will increase your confidence in investing, and once you see your money growing, you'll be motivated to save more and invest more, and things will just snowball from there. By the way, let me know in the comments, guys, what's been holding you back from investing sooner? Is it fear, lack of knowledge, or something else? Drop your thoughts in the comments down below. I'd love to hear from you. But here's one thing that can stop your money snowball from getting bigger, and that's when you're forced to sell your investments when the market is down because you need money to fix that water pipe burst or pay for the down payment of your first home or something else. Imagine selling $30,000 worth of stocks at a 30% loss just because of a lack of planning. And that's why it's so important to separate savings and investments. Roughly plan your big expenses within the next years. Then park that money in something like a GIC or something that's easily accessible, ideally not in a growth stock that fluctuates a lot in value. And also make sure that you've got an emergency fund in cash. Mainstream advice says this should be between 3 to 6 months of living expenses, but in my opinion, you can get away with less, but at least 1 month of living expenses if your job is relatively secure, you have healthy savings each month, and have no dependents. So each month, simply split your funds into your emergency savings or other savings goals and your investments. For example, put $100 here and $100 there. Put your money into these separate boxes depending on what you need the money for and when you need to access it. And also make sure you don't have high interest consumer debt before you start investing, because that can negate all your investment gains. By the way, guys, I've noticed that less than 20% of you are subscribed to my channel, but if you enjoy my content and want to hear more from me, then please hit the subscribe button and turn all notifications on. I'll give you a second to do that while showing you a picture of this cute brown bear I saw at Calgary Zoo. Carefully consider how you want to go about investing. Many beginner investors leave it to others, the nice investment advisor at that bank, thinking they know best how to manage your money. But is that true? What's certain is that they, the banks, charge a high fee for managing your investments, anywhere from 1 to 3% of your total asset value. 2% of $100,000 is $2,000 disappearing from your wealth each year. And the thing is that there is no guarantee either that your money will grow faster with their investment strategies. Personally, I don't like paying an extra 2% or so that shrinks my portfolio over time. While investments can compound, so do fees. Instead, I prefer to manage my own investments. Most online investment platforms nowadays offer the choice of either managed investing or self-directed investing. And my personal tip is to use self-directed investing. Again, this is not financial advice. This is just how I like to do it, because I get to decide exactly how much I want to buy and sell of what, and it forces me to learn more about investing instead of leaving my financial future in someone else's hands. And for full transparency, I have investments on several platforms online, but the one that I've been using the most is Wealthsimple. It's just super easy to use, even for beginners, and most importantly, there are no account fees, monthly fees, or trading fees for stocks and ETFs, so you keep more of your money. You can even get a $25 bonus straight into your new account if you use my referral code in the descriptions below and fund your account with at least $1. It always amazes me when I hear people waiting for the right moment to buy.
I'll wait until this and this stock goes down from 110 to 90 and then I'll buy 10,000 all at once.
As though anyone can really predict how the market will go. Exactly. But the thing is, you can predict the market. So don't hold off investing because you think stock so-and-so will dip in 3 months. Trying to time the market, predicting when to buy low and sell high often backfires, even for professionals. The market's biggest gains typically happen in only a few unpredictable days. This chart here shows how drastically less returns you would earn if you try to time the market. And emotional investing makes it even worse. People tend to buy when prices are high out of FOMO, and then they sell when prices drop out of fear. A smarter, more reliable approach is DCA, or dollar cost averaging, which means investing in a fixed amount at regular intervals regardless of market conditions. This strategy removes emotions from the equation. You buy a bit more shares when prices are lower and fewer shares when prices are high, lowering your average cost over time. DCAing helps you build discipline and stay consistent. Connected to this is something that many people try but the least are successful with, and that's day trading, when you try to make quick profits from buying and selling stocks or other assets within the same day. And because emotions like fear or greed can cause day traders to make impulsive decisions, they often end up buying high and selling low, which leads to losses. The reality is that only 3% of day traders actually make a profit and only 1% do so predictably. So instead of risking being the 99% who just loses out, do this instead. Buy and hold. Choose long-term investments and hold through ups and downs, and sell only if the fundamentals, so the company's core financial health and performance indicators, change. As Warren Buffett said, our favorite holding period is forever. So let compounding do its magic. But one question you might ask is, as a beginner, what should I invest in? Your colleague might be raving about some stock to buy, but it seems that even they don't really know what they're doing either. Investing in individual stocks is extremely high risk if you don't understand the company or the market. It's easy to get burned. Now, I'm not saying that you should never invest in stocks. I mean, I do. But if you do, you really got to dive into more details and not just look at the price movements. Look into things like the company's financial statements, business models, and long-term prospects so you know what you're really buying into. But if you're not ready for that, or you just don't have the time for that, my next tip would be to buy index ETFs. ETF being exchange-traded funds. Index ETFs are basically funds that track a broad market index. One example of an index is the S&P 500, which includes the 500 largest US companies, giving you built-in diversification across many stocks. And this removes the guesswork from picking the winning stocks. And because index funds are passively managed, so no managers deciding what stocks go into the fund, they have much lower fees. Again, I'm not saying never to buy individual stocks, but if you're a beginner, start with a solid index ETF. You can check out my favorite ones up here, and as you learn more about investing, you can then start diversifying your portfolio further on your own. Remember, diversification is all about managing the risk in your investment portfolio. It spreads your money across different assets, so one setback doesn't derail everything. What happens is that many beginners fall into these two extremes, either leaving everything into a checking account earning almost nothing, or jumping into guaranteed 10% returns that are too good to be true. But here's the truth. No risk, no reward. If you play it too safe, you risk earning nothing, and inflation will slowly eat away at your money. Successful investors don't avoid risk, they take informed risk. So remember the next tip, which is to be smart about risk. You might be able to afford more risk, or you might want to stay more conservative. It's a personal choice. Just don't rush into anything, and don't just follow mainstream advice just because someone else said it. Really think through how much risk you're willing to take for the possibility of a higher return. One example in my personal life is investing in Bitcoin. At first, I was scared to invest in Bitcoin, naturally, because I didn't understand much about it and I didn't want to take any risk at all. But after a while, I realized that my investments at the time weren't gaining much either. Now, as I learned more about how Bitcoin is the only scarce, decentralized digital asset with a fixed supply, and after a lot of studying, believing that Bitcoin will continue to go up in price, now I believe that I cannot afford not to invest in Bitcoin. But again, this is not financial advice, this is just my own take. The point is that whether you're looking at index funds, stocks, or even something like Bitcoin, make sure that you don't start off with a mindset of avoiding risk entirely, because not taking a risk is a risk in itself. By the way, guys, I'm curious to hear your thoughts. How much risk are you comfortable taking with your investments? Are you more on the conservative side or willing to take more bold chances? So let me know in the comments down below. And once you start investing, here's another pitfall to watch out for. One that can quietly eat into your gains, and that is taxes, which are high in Canada. In Canada, your profits, whether it's interest, dividends, or capital gains, can be reduced by around 20 to 50% depending on your income bracket. To reduce the shattering impact of this, I give you the next tip, which is to save taxes with registered accounts. By using these accounts like the FHSA, TFSA, and RSP, you can legally reduce the taxes you pay on your investment earnings and grow your money faster. In general, if you're planning to buy your first home soon, consider investing into an FHSA or first home savings account. The TFSA or tax-free savings account shelters your investment gains, and it has more flexibility when it comes to depositing and withdrawing your funds, which makes it ideal for most people. The RRSP or the Registered Retirement Savings Plan is especially powerful if you're currently in a high income bracket. How it works is that money deposited into an RSP reduces your taxable income. So the higher your tax bracket, the more taxes you will save in the present. But there are a lot of nuances and details to this, so if you really want to figure out which account is best for you, then watch this video above here later. This is really important because picking the right account could save you thousands of dollars in the long run. And also, don't forget the following thing, which can instantly double your money. If your employer offers group RSP matching, often they would match your contributions on a one-to-one basis. Don't leave that free money on the table. And now guys, to my bonus tip, my meta tip. My bonus tip is to invest into investing. If you just invest and follow mainstream advice, you can get very far. But if you invest your time and mental energy into learning about investing day after day, year after year, can you imagine how much faster your wealth will grow? My 9 tips today cover everything I think that a beginner needs to know. But don't fall into the trap of thinking that you're done once you've learned the basics. Investing is really a lifelong journey. So stay curious, stay open, question the advice you hear from others, even from me, because what I'm sharing here in this video is my own belief based on my experience. Ultimately, you will need to find an investment approach that fits your life, your values, and your goals. That way, your money can truly work for you. That being said, in case you haven't started investing yet, but are ready to start your investment journey now, continue to join me in this next video here where I review the online investment platform Wealthsimple. Thanks for watching, guys, and I'll see you in the next one.